next up is Chris is up, right? And Chris,
Yep.
I'm going to share results of the poll that we were running on FinTech in terms of general interest, so that way the panelists know what to do. And I'm going to launch another poll, which has more to do with questions they want to ask the panelists. So why don't you go, Chris?
Thank you very much, Marty. Thank you for pulling this together. That was a great segue into the opportunity in FinTech. And even today in the journal, Visa was kind of beat down by the Department of Justice on their acquisition of Plaid. And basically the driver is it might not be good for consumers. It was, they're expecting better, more competition, lower prices to the previous comment, and better service. So we're really going to take a deep dive and extremely excited about this panel. So we're going to go through and introduce the panelists. Panelists, if you would just introduce yourself, quickly your background, and then quickly just kind of jump into your mission statement, kind of what you're providing, and then we'll jump into the questions. So hello, if I said that correctly, can we perhaps start with you? Are you on? How about you, Nick? Why don't you go ahead and start, Nick?
Sure, great. Thank you very much for taking the time, and thank you all for listening to us. My name is Nick Marcola. I wear a couple different hats. One is a venture partner at a VC fund and a CIO of our own family, and more importantly, I'm also CIO of a FinTech startup that I'm actually most excited about. In terms of background, I spent over 2 decades on Wall Street working for very large financial institutions. Worked at Bank of America, worked at Citi, then worked at Tom Weisel Partners, worked at a hedge fund. Then for about 10 years or so was the head of research for a multifamily office / private bank out of Greenwich, Connecticut. And then a couple of years ago, decided to take a turn, focus more on the startups in the space. And while doing that, came across a company called Your Capital, which is a fascinating FinTech startup dealing with the do-it-yourself and investment crowd, folks that actually rely on themselves to make financial decisions and simplifying their lives, making it a lot easier for them to understand what they have, understand their portfolios, and also make investment decisions going forward. So in a nutshell, it is the inverse of Robinhood, because Robinhood is probably a great tool for day traders, people looking to day trade, versus Your Capital is the opposite. It's a great tool for investors, for folks that understand that they don't have the skill to day trade, but they do understand that building wealth and preserving wealth on a longer term basis is done through private investing.
Wow, that's great. Sharish, are you on the line with Weatherstorm?
Let me unmute him. He may be muted. 1 second.
Oh, sure.
Okay, I just unmuted him, and I'll be he'll be starting video right now. Go to the next. Maura, why don't you introduce yourself?
Well, thanks everyone. A pleasure to be here, and I will briefly introduce myself. I teach finance in Italy and Switzerland, and I am an advisor of the European Commission, in particular for the new program Horizon Europe. Horizon Europe is the main program for innovation that will be started in the next few months and will end at the end of 2027 with a budget of 85 billions. I helped the European Commission to select a project that will be funded with equity and a non-refundable grant in the FinTech space and innovation in general. Furthermore, I am an equity partner of a pretty big family office here in Switzerland that is SMC. SMC has 15 physical locations in 15 different countries, and I am also an equity partner of an asset management company that is named Ethica Capital. My interest in FinTech is above all about security token offering. I am the founder, together with the family office, of one of the first platform in Europe for digitizing assets. The name is European Digital Asset Exchange. It's a platform with a primary and secondary market for security token, and maybe later I will have some possibility to give you some details about that.
Wow, that's great. Thank you. Shirish, are you able, or hello? How about Alan?
How are you? Alan Reed. I'm out on my own these days. I'm a veteran of financial services. I like to say, kind of was fintechy before there was fintech. At Morgan Stanley, Dean Witter kept sending me to the lawyer's office every time I would touch technology. But I helped the firm build CRM when there wasn't such an acronym. Was on SunGuard's Expert Solutions, helped them build out with Markowitz for 10 years, mean variance optimization, and worked with their respective partners and academics. Ran Morgan Stanley's online brokerage in the 90s, back before there was, when we offered trading on a Palm Pilot. And ran an asset management company called Forward. Explained and coined the word liquid alt, bringing new technology and new vision to mutual funds. Worked a lot with the family offices. My partner was Gordon Getty. And I'm working with a number of different family offices in tech, and also focus on proxy voting and basically looking to democratize proxy voting with financial technology.
That's a big challenge for sure. Jan, are you on the line, please?
Hi, thanks. Jan Perullo from Extrema. Most of you probably just heard my colleague Daniel Sachkoff speaking, so you know a little bit about my company and what we do in the fintech space. So Extrema was started as a quantitative modeling company. We did a lot of risk analysis, factor analysis for large portfolios, mostly institutional portfolios, and we've gradually moved into the 401k space. Daniel has discussed, and we can talk more about that. But my history, I started off in fintech. My career started at fintech at a place called FactSet Research Systems, where I was the head of quantitative solutions. From there, as many people that start off on the fintech side, you kind of get this idea that you can do it too. You can do the investing too. So I moved on to the investment side of things, worked for a few different hedge funds in the New York and San Francisco area. Eventually one of those was acquired by Guggenheim. And from there, I spun out to work at an outsourced CIO where we managed defined benefit pension assets and also nuclear decommissioning trust assets, which is a pretty esoteric area of the finance world. And then moved on to a family office before landing here at Extrema. So that's kind of real quick overview of my background.
Oh, thank you. I see Shirish on. Shirish, would you, if I've said that correctly, Shirish?
Yes, hope you can hear me. Can you hear me?
Yes.
Okay, thank you. We are a machine learning AI-driven hedge fund in San Francisco. We used to be in San Francisco, but we relocated to Incline Village because of COVID and a few other things. I'm a former PIMCO head of their global bond investments. In between, I did a startup or two, which was sold to Allianz Global. And now we are in the third iteration of my startup, serial entrepreneur. We do everything driven by quantitative investing, use large data sets as well as AI and machine learning for trade signals, portfolio allocations, asset selection, and risk management. Have about 350 plus million under management, and we also have a legacy business where we help clients design factor-driven ETFs. And we have designed roughly about $1.7 billion worth of ETFs, totally driven by systematic risk premia type of factor investing.
Awesome. Thank you. Thank you. And is Alo on the phone?
Yes, I am.
Hey, how are you?
Good, good. How are you?
I'm doing excellent.
Background, is that what you're
Yeah,
looking for?
just name, background, kind of what you're up to, kind of what you want to explore today.
Right. So very quickly, I started my work life as a finance professor at Wharton, moved on to help start the Corporate Finance Center at McKinsey. After that, I was a sovereign wealth fund manager in Southeast Asia. And since then, I've been a advisor and an investor in a range of fintech startups at Silicon Valley. I live on Sand Hill Road, so I breathe and smell venture capital. And so right now, I have been doing a lot of work on AI in fintech, and I would like to share some of that experience with the panel and the audience.
Well, why don't we jump off on that? There was the panel discussion. Some of the questions were incorporating AI, machine learning, and improving client servicing outcomes, financial outcomes, structural outcomes. So maybe you could share a little bit about what you're up to, what you're working on, kind of size of the market, and where you want to go with it.
Yeah, so while fintech has really thrived over the last couple of decades, and particularly last year with the pandemic, it's really excelled. Unfortunately, AI has lagged significantly, and there are a couple of reasons for that. One is data. AI is based on big data, but unfortunately, finance is an area where data is very minimal because we need time series, so we are restricted by time in terms of how much data we've got, and 95% of the data is unstructured. So we are on the cusp of dealing with these problems. There is a whole industry coming up within AI that creates what we call synthetic data. So we take the original data and use some algorithms called GAN and generate synthetic data. That's one. The other thing is for the unstructured data, thanks to Google and a company called OpenAI in San Francisco, we have two machine learning machines that are amazing. One is called BERT, that's from Google. The other is GPT-3. And these are models that have been pre-trained in billions of elements and, in almost all the text available on the web and so on. And so now we have these trained models, so we can essentially do a lot of AI work on unstructured data. So I am involved quite a bit with the investments area and insurance, where there's a lot of sort of mathematically intricate work going on in finding out, risk management in investments and underwriting in insurance. So, but there's a whole range of other applications that are waiting to be touched by AI.
That is really interesting, and I can definitely imagine some of the insurance companies want to have a better handle on risk and a better way to go about it. And now I wondered if I may turn a little bit to Nick. Nick, can you share a little bit about your capital and kind of the client experience that you're trying to address? You come from a huge background in Morgan Stanley, Dean Witter, so you kind of know a lot about the end client needs and wants, and would love to hear how you're positioning to help them make sense of sometimes what can be a complicated process in managing money. Nick, are you there?
He's muted.
Oh.
Yes, I'm here. Sorry about that.
No worries.
Yeah, absolutely. So from my days at the big banks, and as I said earlier, at a private bank focused on folks with $10 million or more investable assets, I did see a lot of products and a lot of solutions being created for the ultra wealthy, but not a whole lot for the average folks out there. And if you look at the numbers, there's give or take about 100 million Americans that have money invested in the market one way or the other. What is not well known is about 75% of Americans actually are do-it-yourself investors that do not have an advisor. They invest themselves. How do they typically do it? They talk to a friend or a family member, they read something, or they simply ask someone for suggestions. Or lastly, they might just do Google searches. But the problem is it's not synchronized, it's not well thought out, and it's haphazard. So what we're trying to do is bring AI and machine learning into the picture and automate some of the questions, some of the processes and procedures that say an advisor at an advisor at a high net worth shop does with his or her top clients, to be done using AI and machine learning, and help, let's say, a person with $300,000 of investable assets or something much smaller, where that individual would not be a top client at any of the wirehouses or RIAs or brokerage houses, who technically be sort of not a target of any of the institutions out there. But here, with your capital, using AI and machine learning in the background, we actually aim to remove all the friction. We will see what the investor has done in the past, and the lowest hanging fruit for us, or the immediate value add, is to simply analyze the fees. We have the ability to go and look at your portfolio and analyze everything you've done in the past, and look at the fees that you're paying. Are you getting good results for the amount of fees that you're paying? And at the same time, recommend here the solutions that you might want to consider that have much lower fees, meaning you don't jeopardize on return, you don't jeopardize on risk, but you're reducing your fees. So the objective is to really automate and use machine learning and AI to remove the human element as much as possible, and enable this universe of, give or take, 65 to 70 million Americans who right now are do-it-yourself investors. Thanks to Robinhood, a big percentage of them probably are traders, but we don't need to go in the direction. We know how well day trading usually works for folks that have been around during the dot-com era, or so we know how well day trading pans out. But the objective is to simply, as I said, AI and machine learning to remove friction, streamline the process, provide solutions, and in a very similar fashion. So let's say when you shop at Amazon or somewhere else, you're looking for XYZ, Amazon also tells you about 1 or 2 or 3 other things for you to consider. And then you don't have to waste a day or 2 or 3 to look at solutions. You have information fingerprint tips, and you decide what you want to do. And the best part about this, it's free to the end user.
Yeah, Chris, if I can jump in, just having some of that experience that, Nick really hit on, the broker-dealer community just hasn't gotten there yet. And this using technology, an example is that when I was at Morgan Stanley 20 years ago, I had built an aggregation platform. And the hope was that then would be to basically permission and integrate online technology with advice, like Nick was talking about, for the broader user. Today, the typical advisor still deals with a lot of back office stuff. The sales guy is not good at back office, but using AI, smart and if you will, just smart switches on the technology, an open file could be released like any other technology company does, and deliver that phone call to the person who can solve the problem, not the broker, allowing the broker to be more available for advice. So it's going to be interesting to see what Morgan Stanley does with E-Trade and how they potentially integrate that. But that leverage, financial services is still quite arcane. And there hasn't been that mass work that Nick's talking about, really empowering the advisor and getting all the back office, to somebody who can actually do it in a good and scalable way.
Well, I mean, can you speak a little bit more? It sounds like there's some really low-hanging fruit to address. Is that kind of where you think advisors can enrich the client experience by focusing on really where they really need to employ their emotional IQ, and then kind of downstream through RPA and some AI investments to kind of streamline the experience? Or tell me a little bit about what the biggest issue is for the advisor.
Well, I mean, think about it. The reality is that nobody spends the most, few people are most efficient with their time, right? And typically it's the problem. You end up with like 10% of your clients taking 80% of your time. And those are typically problem challenges that need to go to the operations team, not to the relationship person. So just by driving that and directing that in a smart way, one can become much more efficient and utilize. And I think what we're starting to see is the advice part is being taken away from the advisor. The advisor is much more the sales, the communicator, if you will, and you end up with some sort of AI-driven robo-advisor in between, and then a back end. So I think there's a lot of that that's coming in. And from my perspective, I'm looking at that from a proxy voting standpoint, where everybody wants to be in the ESG space. And realistically, it's like, look, you don't, as you may have noticed in whatever, Georgia or anywhere else, is that if you don't vote, it doesn't count. And the reality is that people are choosing to divest and then not vote. And then they want to have a say in what Exxon does. You don't get both. And unfortunately, America's been fed this idea that you can take your ball and go home and somehow win the game. That's not reality. And so when you start to see what's happening today with CalPERS and CalSTRS and Church of England fighting Exxon, going to start to see an opportunity and I think people wanting to have a vote. And right now, unless you want to go through reams of paper and all sorts of crazy email, proxy voting is not easy, and it should be. And I think from that standpoint, that is an area to me that there'll be an opportunity as well.
It sounds like it. I know as we see the migration to the ETFs, and ETFs could be considered a technology in and of itself. When you do have proxy voting issues, if your clients are Robinhood or you have billions of dollars, 200 shares at a time, and need a proxy vote, it's very, very difficult for the do-it-yourself investor who gets that notification to even know what a proxy voting is. So how do you envision like educating what tends to be billions and billions of dollars, which could benefit through lower fees or better sec lending rates, or kind of into the weeds of like ETFs?
Well, I think I need to spend some time with your friend Alo. But basically what, in my mind, no different than a dating app. With 10 questions, I can basically get an idea of what the person's values are, and then apply that across all of their proxy votes. So, and then the more information somebody wants to give, or building a community. So with proxy value match, we're working on that idea, that basically what we'll do is we'll take the input from the person and basically then vote all the proxies on an automated basis. And therefore allow, if you look at individual companies, only 20 to 30% of ownership is direct. But the problem is that those people never vote. So many times there's super majorities required. And so you never get to a super majority simply because the direct investors aren't participating. And yet they're told that their votes don't count. And it's almost entirely opposite. And then when you start breaking through and you start talking about ETFs, what you're going to see in the new administration is that I was also on the ICI Board of Governors, and what you see is that both Vanguard and BlackRock are going to be under attack by Elizabeth Warren. Elizabeth Warren, for the last 4 years, has complained about their dominance in the space and them being in violation of antitrust. So one of the questions will be, can they really vote? Can they vote their proxies, number one? And what I would say is with AI, you can penetrate or pierce that responsibility and allow each individual investor in that ETF or in a mutual fund to actually direct proxies. Again, it's going to take, I think Alo's probably better here to jump in, but
may I, Chris?
Yeah, please.
Yeah. So the point of view on fintech from the Bay Area is a little different from the East Coast, in that we kind of tend to believe that every startup is a fintech startup. And the reason for that is over the last 2 decades, the unseen part of fintech development is an enormous infrastructure that has been built up. So now, based on that infrastructure, anybody can offer fintech products as an add-on. Insurance is one such. You can add on insurance to virtually any kind of product. Likewise, brokerage services. We are seeing fractional assets being sold at zero transaction costs, and soon there will be fractional sale of homes, of future earnings potential. All kinds of things have been suggested and have been worked on. So the ability to offer fractional assets as well as to aggregate them together, as Alan was implying, is going to happen, and the infrastructure exists for that. So there's going to be an enormous amount of innovation. The problem was that AI could not be applied very fruitfully because of the lack of data. And now that we are there or almost there, I would, we'll see a lot of innovation in products as well as in, tracking individual customers, being able to figure out their entire movement through the fintech world, whether it's banking or insurance or brokerage or what have you, and be able to judge the risk, financial risk that they carry much more precisely. And so that's kind of the wonderland we see here. Whereas in the East Coast, it seems more like catering to the financial institutions and helping automate and take some of the services to smartphones and stuff like that. That's kind of where we are here. In terms of the AI applications, other than what I've just said, there's a huge amount of predictive capability now. I'm working on a startup that's trying to do good old stock market predictions based on some of the most complicated algorithms and mountains of data that nobody's seen before. And believe it or not, there is some predictive power, and it comes about in different parts of the market's operation as we go along. In other words, there is an algorithm to figure out when the market is showing inefficiencies, even if they're small ones, and then for an algorithmic trader to be able to automatically go in and take advantage of that inefficiency. And we know that by and large markets are efficient, but they're volatile and they're event driven and they're sentiment driven. So anytime these things happen, the trades can capture some of that. So very exciting on that front.
Well, thank you. And certainly to that point, I wondered if I may pivot to Jan a little bit, because what I keep hearing out is kind of the 3 buckets of consumers: do it with me, do it for me, and do it yourself. And at times a consumer will want different support from fintech, and they don't always know when they want it. So I wondered, Jan, if you could kind of, from your lens, talk about what you're doing for the do-it-yourselves to do-it-for-me crowd.
Yeah, thanks for the question, Chris. It's interesting listening to the conversation. I mean, the AI solutions that you guys are all talking about are, well, actually, what Alan's talking about is a little bit less sexy. I think proxy voting might be maybe one of the least sexy things. I mean, it's just like something that kind of has to be done. But Alo, you're talking about the way that we've seen AI used in the past, which is hedge funds, traders trying to get advantages, putting their boxes closer to the exchanges. I mean, every advantage possible trying to get. We've seen some of these things along the lines of how we're servicing our consumers, and we're also in probably a relatively unsexy area, hopefully getting sexier, which is the 401k space, where some of these technologies we can see being used, especially what Nick was talking about, where you have these participants in these plans with these lineups, trying to figure out how to best allocate themselves. And that's why you see this big take up of target date funds and things like that. But not everybody wants to just put themselves into a 2040 target date fund and set it and forget it. And so there are better ways to adopt some of this technology for the end user to figure out what their risk profile is, figure out what their goals are, figure out where they are in a more general sense, and use some of these technologies to build those portfolios for those end users. And so that's kind of an application. But for our clients, which are primarily the advisors that have those relationships, we're seeing a few different components. Like you said, Chris, there's different ways that people use our software from a consumption standpoint. One of the things that we're seeing is that these advisors have so much, and it's been alluded to by a few of the other panels, they have so much that they're doing on a daily basis that your software is really fighting for a smaller and smaller portion of their attention, because there's so many different pieces of their technology stack that they're trying to get trying to do, and so much with compliance and everything else. And so what we've seen is this kind of trend towards do it for you, and AI does fit there too. So it's what we've called do it for you, and it's this aspect of it. I can just give you a brief example of one of our products. So one of our products is sold to the end user, to the advisor, and it's for them to help market their services to plan providers, so companies. So what do? We have all the data about the plans because that's publicly filed with the DOL. So we had a really nice tool that aggregated all the information, and it's great, but it's a commodity, and so many people can do it. So how do you add value from there? Well, the next thing you can do is you can start to help people build their businesses. They can help start advisors to build their books, build their pipelines. And so we created a marketing tool within this application that takes this information that we've aggregated and is able to put it into these nice email formats and send it out. Okay, so like a constant contact type of thing, except with really pertinent information for that end user, for that recipient of the information. Well, that still wasn't enough. So we had to get contacts. So then you have to build up the contacts for the client. You have to bring in all the contacts that they might need to reach. And so you're doing all of these little components for them until the kind of the culmination of it all is writing the email campaigns, writing these things. And now we've actually gotten to the point where we've offered a concierge service, which is actually sending it for them. And so these are things that are less sexy, but still for people to get this value out of your software, they require different levels of service that you can provide to them, and they're willing to pay for it, which is really interesting. But we do have a way that AI can help there too in different areas, and we're using that. Maybe we can talk about that a little later. I don't want to monopolize the conversation, but there's really these variants, even in a tech company, of still having to kind of roll up your sleeves and get your hands dirty to help your clients really get the value out of these tools, which are, the tools themselves have a lot of technology behind them and a lot of automation, but you still have to get your client to that point where they're actually using it and doing it. And they're still, and we've seen this happen with, countless different of our competitors, where it's just like, you buy this thing and it doesn't get used. And so just trying to get those dollars to be more usefully spent has been what we've been concentrating on quite a bit here at Extrema.
That makes a ton of sense. I'd like to pivot to Mauro, and then Shirish would like to follow up with you. Mauro, you talked quite a bit about security token offering and your digital asset exchange. And I had the ability and fortunate to run a global business for UBS, and I realized there's different perspectives. So I wondered if you could share from a European perspective, kind of what's happening with the digital exchange and all of that, if you would please.
Sure. Well, I have to say that I'm based in Switzerland. That right now in Europe is probably the most advanced country in digital assets and security tokens. Just probably, for example, that the Swiss Stock Exchange has created a platform that is the Swiss Digital Exchange that actually is an exchange built on the blockchain that actually will work for security tokens. Now, the idea was to start it at the end of 2020, but there has been a delay caused by the pandemic. security token offering is something where I have done some of the first, I would say, deals in Europe. For example, I am the advisor of BitBond, that is the first security token offering in Germany with a prospectus authorized by the German SEC, that is BaFin. I am the advisor, and it's also on our platform, the first Italian security token offering that actually is an Italian startup. What is very interesting here in Switzerland is the possibility of digitizing in a safe way stocks of a company. It means that we can write inside the articles of incorporation that the shareholder registry will be kept on the blockchain. And this is a huge advancement, because it means that when you transfer the token, that is actually the share of the company on the blockchain, you are also transferring the ownership. And it means that you can use a decentralized exchange like the one that we have created, the European Digital Asset Exchange, to trade that security token. Now, try to think of the impact of this possibility for all the illiquid assets that there are around and that can be used to diversify portfolio. Actually, this if you go and you Google over future, that is this project that we have 3 projects now on the platform and other 2 that will be uploaded in the next months. If you Google over future and Eurodax, that is the old name of our platform that we changed a couple of months ago, you will see that there are many different sources and website. I think also LexisNexis in USA spoke about us, because we have been, I think, the first in Switzerland to have been able to do a security token offering properly. It means using an articles of incorporation, where inside the articles of incorporation were written that the stocks were kept in a digital way, while many other security token offering that have been done in the past have been done with a traditional articles of incorporation. But there, at that point, you are running a risk, because when you buy the token, you are missing the link with the stocks. So it's important to use this type of strong connection. It must be something that is must be written inside the articles of incorporation and must be accepted by the public register in the country, like in Italy. Sorry, like in Switzerland. But for example, in some other countries in Europe, this is not possible, because, for example, in Italy and in Germany, by the way, I said that I was the advisor of BitBond, but in that case, it was a bond and not stocks. But for stocks in generally in Europe, like Italy, Germany, and many others, you have a public register. And it means that you are not able to use blockchain to register shares and to transfer them. So at this time, at this point, we are able to digitize stocks in a safe way just from Switzerland. So usually when we have companies and clients outside Switzerland, we create an holding company in Switzerland that is keeping the shares of the subsidiary, and we digitize the holding company in Switzerland. This is the way we do. And then once you have raised the capital, and clearly you have the advantage of having a natural possibility to raise capital from the crypto market, because you are naturally on the blockchain. Then once you have raised the capital, you can open a secondary market built on the blockchain. You can transfer everywhere, anywhere the shares with actually almost no cost in an instant way. So I think that is something really, really interesting that will have an impact, a strong impact on capital markets.
Chris, may I make a very quick point regarding Mauro's? One of the looming dangers of blockchain and crypto is quantum computing, which, as most people know, can crack through the key system in blockchains quite easily. Now, we are still 5 to 7 years away from commercial quantum computing, but most people don't know that there is an existing hardware with IBM that anyone can use for free that can be used to crack encryption codes, number one. Number two, that there are algorithms which can be used even on regular computers called quantum annealing. And with using those, we can also crack into the blockchain system. To me, the blockchain system is not as sacrosanct as it's made out to be. It's got a lot of vulnerabilities. Again, these will all be bridged down the road by smart people who work on them. But right now, it is vulnerable.
Yeah,
Well-
I agree, but I think that I mean everything is vulnerable. You are always running a risk in some way, somehow. There is always some kind of risk that you run when you do something. So, I mean, this is a very interesting observation. But at the moment, I would say till now, blockchain is still there, and Bitcoin is almost to $1 trillion of dollars.
Hey guys,
I think
so
we'll know when
I just
you
want to cut in
can.
here for 1 second. So, you know, we've been running a poll and we got the poll results of what the audience wants to hear about from the speakers. And the number one question was, are there any greenfield spaces left in fintech, such as, you know, banking the unbanked, microfinance, and what are the largest green spaces that you see right now? If you guys can look at that, you know, poll results, you know, there's a couple of questions. You know, are fintech valuations too high, low, or just about right today? And what's the best market segment of fintech to be in outside of the segment that you're in?
Well,
Yeah. Hey, Marty, I saw that. It reminds me, I sat down with my buddy Mike when he went back to Stanford, and he was doing something that seemed really boring. It was student loans, you know, and many of you may have heard of SoFi. Well, that was Mike Cagney. And, you know, the reality was when we were just brainstorming, to me, it seemed like, well, it seems like everybody's been there. Well, I don't know. A unicorn's not a bad thing to start off with, right? So I do think that what we're talking about here is really interesting, what Mario's talked about. And I know Aldo's got a way to break it, but until those Satoshi's, Nakamoto or whatever's Bitcoin disappears, I guess the blockchain's still somewhat stable. So we'll see when somebody pulls those Bitcoin out. But I do think that it's interesting to think about, as Ala was talking about decimalization and fractionalization, and if you marry that with Maro's point, really what you have is the future platforms, future exchanges, where you actually, people can know who owns them, they can own portions of them, they can have real data that you can actually do more data. And whether you're a mutual fund, an ETF, or whether you're ExxonMobil, today you don't know who owns your shares, and you pay, you know, what's been termed bribery to companies like Broadridge for bad data. You know, the reality is that in a blockchain world or an environment like Maro was talking about, you have much better data set, you have real-time data, and people can function much better. So then when you all of a sudden throw AI in there, I think that you've got greenfield galore. It's just a matter of which area of service you want to deliver, but the opportunity to deliver real service on a real-time basis all of a sudden becomes much better because there's transparency.
Yeah, so you know, so I understand where blockchain comes in. I don't know what the size of it is in the fintech market. I'm going to wager that it's a lot smaller than most people talk.
Yes.
So what I would like to do is divert the discussion back to fintech business and businesses that are investable today, and what the expected timeline should be for return on investment on those businesses when you're making them, right? So right, because to me, and we covered ICOs, we covered blockchain for many years. We've been in this since 2014, but the reality is, I see blockchain as a feature these days and not a selling point, right? So to me, blockchain is the same as nanotech. It's implicit, or who cares, right? I mean, all I know is like we have like fantastic sportswear these days and fantastic technology where things are like super hard that are ultra thin, and nobody cares. It's just assumed. So to me, blockchain is the same assumption. It's not something new. I have a degree in math. I've got a computer science background, but I went to Wharton, whatever. To me, it's all the same. Blockchain's not new. So I'd like to move on to opportunities in real business. So if we can do that, that would be really great. And again, our question was, what are the greenfield opportunities? What are the best market segments outside of your own opportunities that you're in FinTech? And how do you find deals? Where does deal flow come from? I mean, this is kind of like just real essential business, right? So
let me
why don't we go with you, Shirish? Because I know you've created a lot of businesses, Backbone, participating in the ETF business, asset management. So why don't you field that question, if you will, and we'll get right back to you.
By question, you mean where I see opportunities outside of our own business?
Yeah, I mean, framed in your own business, and then underserved markets, and I think Marty's point is really good. A lot of you have raised money, will raise money. The fractional shares notwithstanding, valuations. Jamie Dimon was pretty loud and proud, like, I'm just going to gobble anything that looks like I need to catch up, and I'll pay up for it. So it'd be interesting as a follow-up, kind of valuations, how you're sourcing deals, what kind of deals you see in the future, and kind of what are underserved markets from your lens.
At least at this stage, we are not doing any private investments. I mean, on the personal side, I have some private investments here and there in some automating, let's say, back office, middle office type of operations for either advisors or money managers. So I will leave that question for others who are involved in it and traffic in it a lot more than I do or we do. In terms of our own AI machine learning applications, we have large data sets and we keep building lots and lots of trading signals, factors timing signals, asset allocation signals. So that's what we do, and we don't sell that technology. I mean, if I have a technology that's good, I'm not gonna sell it. I'm gonna use it for my own investments or own strategies. So we have looked at other strategies that say, oh, I have this great model that makes 1,000% a year. If it's that good, why are you selling it? So that's the first question that comes to my mind if somebody's coming to me selling any kind of fintech idea for trading and investing. If it's a platform idea, we have looked at it. Invest Cloud being the one that I've been involved with as an investor from, I don't know, since the inception. They're doing a great job of servicing hedge funds and money managers. Lattice Strategies, which was founded, now bought by Hartford. I was involved with them. The most recent one is a VIA that I'm involved with personally. I own a nice chunk of it. They do automated trading for ETF business, so you don't have to worry about designing an ETF. You just hand it off to VIA, and they do the entire middle back office creation redemption. So those are three examples of private investment that are done in fintech space. On our company side, I'm an engineer by background, almost a PhD, but dropped out before writing my thesis in chemical engineering. And since then, I've been building models for creating signals, risk management, asset allocation, things like that. I use that in my own trading, having built a #1 ranked global bond fund. I use that in that. And more recently, now we have in the managing of a global macro fund. So we choose which asset classes to be in, how much leverage we want to be in the core portfolio, and then the trading portfolio, which is a risk managed, let's call it alpha generation. We use that technology for generating future signals. So those are types of ideas that we employ. And without going to all the details, but we feel comfortable in running those models. And I think in the years out, we will market those, not the strategies, but the fund opportunities a fund using pure AI and machine learning for futures trading. Thank you.
Although you had a comment, please.
Yeah, quickly. Shirish, makes the point that everybody does, which is if you have a mousetrap that produces money, why would you sell the technology? The reason is that we want everybody to have it, not a few hedge funds. Number one. Number two is that all the algorithms are open source. All the data is available from the market. So there is nothing proprietary out there that hedge funds do. They can be easily replicated. That's one thing. In terms of Marty's question about greenfield areas, one simple one is adding insurance products to every kind of service that's available today. We can get into detail later on about that, but that's beginning to happen. Just like you get, when you buy a product, you get a prompt for, basically a maintenance or a warranty. Similarly, for all kinds of services, there are insurance products that can be added on. The infrastructure for that exists today. There are two areas that have somehow never been there's not been any startups in it. One is remittances. So workers remitting money back to their homeland is about a $700 billion market. The World Bank has been trying to get people to figure out a way to minimize the transactions cost. Today, the transaction cost for that 700 billion is 7%. That should be close to zero. And it's a tough nut to crack because much of the money is unaccounted for, it's cash and all of that. And Western Union is the one that, runs with all the profit there. What was the other one?
So if I can just add one more thing, I think, Chris, voice is an area that, back to Marty's point, what is the greenfield? If you look at companies like Zamo that are doing voice aggregation, if you think about Alo's example just now on insurance, if I could just call a number or ask Alexa, what kind of coverage do I have on my Tesla? What's the annual return on this stock? And it would automatically be able to just fire it back to me. All of a sudden, that changes things. So apps that work driven off of voice, I think are, especially in the financial area, are going to start driving a lot of change.
It's a very good point because Mark Cuban has said that all kids should be writing programs on Alexa and Google Assistant because those are going to be very large and you don't need venture capital to do that. And these are, the programming interfaces are very simple.
What Zamo does is they aggregate all those voice channels so that you basically you program into one, and then it goes across all the 7 different voice channels that are out there. But I think kind of going back to one of the things Nick was talking about is it's about scale, right? Technology is all about scale. So the more you can get out to a broader group, and most of us are okay speaking. When we start hitting the keystrokes, it's when we start falling apart.
Talking of scale, financial inclusion is a very large area. There are 3 billion smartphones out there with payment mechanisms built in. And that's a totally unbanked area. And people are trying to figure out how to get to that market. But there's going to be a lot of innovation in that financial inclusion. And there's a lot of venture money from international institutions on that front.
Well, one of the questions I thought John had questioned about banking for the unbanked. What type of greenfield opportunities do we see in that space? That was one kind of a high interest in. And to your point about financial inclusion and reaching, to the accounts that perhaps the ultra high net worth advisor community wouldn't, work for or work to. Anybody want to comment on that?
Sure,
Yeah,
sure.
sorry, go ahead.
Yeah, go ahead.
If you go to China, which I'm sure many of you have, you'll see that nobody uses credit cards. Nobody goes to a bank. Everything is through the smartphone. Even if you are buying street food, is through the smartphone. So the smartphone can be a device for any kind of financial transaction that's required. The problem is that each of the user is so small in terms of dollars that nobody kind of has figured out a very low transaction cost way of doing this for the unbanked. Okay, because the infrastructure exists; it's all there. It's a question of making things happen. For example, microfinance works, micro insurance works, but those have never been brought into the smartphone world. They're physical distribution of cash. So I have no idea why the people have not done anything in it. It's just ripe for invention and innovation.
Nick, do you have a comment there?
Yeah, a couple of comments. I actually grew up in a communist country in former Yugoslavia. What you need to keep in mind when it comes to banking, in underdeveloped or poorer countries, there's a significant distrust of banks. So people don't trust banks. I'm talking about the lower layers of the society distrusting banks. And if they have a device or a smartphone or so they can do transactions on one end, they'll probably do it based on what Allah just said that takes place in China. For example, Sweden was the first country in the world, I believe, to introduce the paper currency. And it's the first country in the world to actually eliminate the paper currency. So you can live in Sweden today without having any access to paper currency. So I'll also throw a number. There's 3 billion smartphones, but there are about 7.8 billion people in the world. So still have more people out there that don't have access to technology and don't have access to banking. In the US, I've seen a number of companies that are actually going the different route. I know Walmart tried to open up a bank and did not go well, but there's some fintech startups empowering larger companies like dollar stores or so where they can start a bank. So dollar store, I'm just using this as an example. I'm not saying dollar store starting a bank or so, but there's a fintech in the background that's using the plumbing of a bank. Now, customers that shop at dollar stores or so can actually bank and have the brand loyalty. So an opportunity is definitely there in terms of leveraging the brand that's well known that people trust, and especially as I just mentioned earlier, in some of the poor countries where people didn't trust banks to begin with, and especially countries that had very high inflation rates. Anything you put in the bank a day or two later, or a month or a year later, that was worth a lot less. It made no sense to leverage banks. And I also want to echo what Allah said about the remittances and payments. It is a huge opportunity. It's a tough nut to crack, but there's so many workers out there and globally that actually send payments home, and then Western Union is making like a bandit. But in my view, the challenge there is that blockchain is probably not accessible to, I don't know, a hotel maid or a garden, or someone who's sending money home. That person probably does not use blockchain in any way. So those are the opportunities in my view.
One other very large application waiting to happen is the use of blockchain for individual wallets, so that when any company takes my private information.
Where are you off to?
Sorry.
Oh, someone, please mute your phone. Yep, go ahead.
Okay. So that whenever Facebook or anybody else wants to use my private information, they have to put in money into my wallet, and hence share all the billions with the population whose information you're using to make money. Now, everybody knows about it, and the technology is there, but nobody's doing it. Basically, it's an identity card with a wallet built in with blockchain. That is the front for any person to be a part of a social network or a search engine or anything else for that matter, and make money out of that by selling private information.
Yeah,
I'd
that's
say that
certainly-
if you kind of marry Marty's question with yours, that focus on stakeholders is going to become much larger, and trying to aggregate data from stakeholders and communicate that to companies and governments is going to become more and more interesting. So maybe not non-banked, but not necessarily owners of assets either.
So Mauro, I wondered if you have spent time thinking about that, as in particular across pan-European markets and even in some of the kind of emerging markets. Do you have a sense where banking, the non-banking, and what kind of fintech opportunities there are to fulfill that need?
Well, I think that at this point is just about the creativity. It means that in order to spot new services, new spaces, it's just about thinking how to connect the dots. It means that you have many different technologies. You have artificial intelligence, blockchain, big data, digital payments, deep learning, and so on. And every day I'm seeing something new that is that has been created by connecting some of this technology. For example, I have seen the use of digital payments and artificial intelligence in a peer-to-peer lending platform, where artificial intelligence actually is used in connection with the digital payment, so that the platform is updated in real time on, let's say, the daily income statement of that activity. And this it means that they are able to create a rating system of that company that is much more efficient than a traditional ranking method. And this means that they are able to apply a much better interest rate, solving one of the problem of this field that is called asymmetry of information. I think also that artificial intelligence, to come back to one of the initial point, it's a very interesting technology that must be considered depending on which field of fintech you are applying it. It means that psychological, for example, in robot advisory and algorithmic trading, there are some researches that show that trust is a very important thing that must be considered when you are going to apply artificial intelligence. There is an algorithm aversion by people, and that they may choose to use an algorithm when they have not seen any result, but in case that the algorithm is going to fail, they are going to avoid to use the algorithm again. And many times people would like to change the algorithm even a bit in order to be to use the algorithm more. And I think that this type of psychology must be considered when you offer a service regarding robot advisory. Another important thing that I would like to highlight in fintech is that I am seeing now many different startups receiving a huge amount of money, above all in the digital payment field, and actually they are not making revenue. Many of them are burning a lot of cash, and this clearly it's a risk that must be highlighted when you think at opportunity of investments. I think, just to conclude, to answer to the question, that creativity in connecting the different technology and the different data that you have, it's the solution to offer services to unbanked people, and probably to create value in emerging countries.
one
Well,
thing became
Marty, I think we're up against the clock. Do we want to have any kind of final thoughts from the panel?
If I may, the one thing that became evident during the pandemic is
I
that,
just want to let you know, you guys have 10 minutes, so keep on going.
oh, okay. So in the pandemic, when the PPP money was being distributed, it was a mess because the United States doesn't have a direct channel between the consumer and the government. Take India. India spent billions of dollars to get a digital connection with 1 billion people in the government, so that when grants are made or anything is doled out, it goes directly to the people rather than through middlemen who, use up a lot of the. But it also can be used for crowdsourcing. There's a lot of need for data that can be used in AI, which can be crowdsourced from, assessing the risks of things, assessing the value of things, and so on. So Fintech has built and are beginning to build the infrastructure for entities like the government or NGOs to connect directly with consumers. And that's a huge thing down the road.
So we had a question or a comment by Jeff online about, Africa and some of the unbanked kind of going back to the opportunity for society, maybe, mobilizing the frontier markets and helping their economy develop. But certainly there doesn't seem to be immediate P&L to address frontier markets, where, as Alan has commented, that some of the developments in the U.S., there's a lot of fintech being applied to kind of unravel the maze and make it more efficient, where markets in EM and frontier markets can just skip the last 20 years and kind of go right to it. I'm wondering if some of you have any comments around, improving society in general, and if there's not a P&L, what do the family offices from maybe through an SRI lens, to address some of the challenges in frontier markets?
Threw out a lot there, Chris. I've been doing a lot in the ESG space, but first off, I think one place that's been successful in these markets is I was on the board of a company called Opportunity Network, and they basically work through banks in primarily Southern Europe, Africa, and the former Soviet bloc. And what they saw was that there's not a lot of communication, and so building those pathways and those opportunities for businesses to communicate across those platforms has been very helpful. My guess is that being able to basically transfer money back and forth as well would be very helpful. I'd go back to just in the SRI, socially responsible space. There's been a lot of talk and a lot of work, and business roundtables come out with conversations around stakeholders and about companies not being run solely for profit, but for people's best interests as well. And so my sense is that there'll be an opportunity to somehow marry that information, deliver the data and to those companies, and provide better data sets across that in the for environmental issues, and also for monitoring and growth in these up and coming countries.
Hello, or Sharish, anybody on that one?
Now, just chime in very quickly. Just looking at comments coming through, I'll be a little shameless and put a plug for your capitalists. Unfortunately, you can't make money in Africa, but you can definitely make money in the U.S. And then Alan made a point earlier about brokerage houses and brokers not being able to provide advice and so forth. With all that being said, I think there is an enormous opportunity in the U.S. to make money. And typical startup in the past was probably 5 or 10 or 12-year time horizon. Now, with a decent startup or someone like your capital can probably get to substantial financial results within three to 4 years or so. And what we're most excited about is that as a startup, of course, everybody's got the best mousetrap, or everybody's got the best way to get to the market or so. But what's interesting about your capital and what we're doing is we're actually going to the market two different ways: B2C on one end, and also B2B to see. We have had conversations with a number of larger companies that are very receptive or very open to providing this solution as a perk to their employees to enhance their financial well-being and knowledge. I know Jan is really 401ks, and in my previous lives I've built some of these portfolios, and the unknown secret there is whenever somebody builds a 401k, the objective is to really protect the company, not provide the best solutions to the end user. And the end user is paying hefty fees, does not know how much he or she is paying, getting mediocre results, and the experience is horrendous. So to the extent you're looking for an interesting fintech, I put my email there, and as I said, I'll put a shameless plug, and we'll be happy to talk more as we're raising a seed round.
Somebody has raised an issue on the chat room saying that, how about the underbanked in the developed world?
Yeah.
And it is true. That's a large population, and nobody even thinks of them. The guy who invented microfinance opened up a microfinance entity in New York to try to do that, but it failed miserably. I don't know why. But
is that Mr. Yunus open in New York?
Yes, Mohammed Yunus. And okay,
I wasn't aware that he opened it. I actually met him a number of times. I know he had some large donors in the past throughout the world. So it's interesting to study why the entity failed in New York.
Well, the model of microfinance in the underdeveloped world is the money is given to the women in the family. Give it to the men, they're going to go to the bar and drink everything, all the money away. So it's given to the women, who then buy an asset that they use to generate income from, whether it's a smartphone or a cow or you name it. So that works very well in the underdeveloped world. In the developed world, it's a very difficult proposition. We have to figure out why there is poverty where there is, and whether it's self-fulfilling, it's a vicious cycle, and how to convert it into a virtuous cycle. There's a lot of intricacies involved. I know that Yunus got a lot of money to do it in New York, and he did it for about 7 or 8 years, and it didn't work out.
Jan, did you have some comments?
No, what I was going to say was I was going to kind of agree with Alo. I mean, it seems like, the amount of money for microfinance, in the US, you can't just buy a cow and make yourself, that doesn't really help you. I mean, maybe a smartphone can help you. Then you have ongoing, service costs and things like that. If you're truly poor in the US, having those solutions at your fingertips it's probably not $100 solution or $200 solution that can be given to you. Whereas, in some of the underdeveloped, underfinanced, underbanked countries, the solutions can be much smaller and much more helpful, which might be why it works. And it's probably not as simple of a solution as Alo points out, of just giving it to the women versus the men in the US, but there might be a way to crack that. Now it's just a matter of what else can you do on an ongoing basis to help lift those underserved, underprivileged people out of poverty in the developed markets.
One thing that can be done is to help not the abject poor, but the lower middle class to buy real estate, buy their own homes as a fraction of the ownership. So many people end up owning pieces of the house, and that's been suggested, hasn't been done. There is another one that's been suggested by Bob Schiller, Nobel laureate, that there should be an insurance on the future earning potential of a person, and that should be a saleable asset. So that's, again, a very intricate problem to solve, but it's entirely doable. So insurance has a lot of potential in fintech.
That's an interesting idea, but in New York, those those people may end up paying through the nose in property taxes. So probably renting may be less burdensome for them, given how much we pay.
Yeah.